All right. Good afternoon, everyone, and welcome back again to the third edition of our Resilience and Practice series. Again, as context, of course, when we started this series, we expected this to be a relatively short response to an extraordinary period of geopolitical uncertainty. Yet, as events continue to unfold, it's become increasingly clear that resilience isn't a one-off discussion. It's something that we all need to take into account, and organizations really need to look at it as a permanent leadership agenda, certainly if you're operating here in the Middle East and to some extent globally as well. The good news is that since we started this series about 3 months ago, we've seen some encouraging developments. Shipping through the Strait of Hormuz has begun to recover, as we've seen over the past few days. More tankers are flowing through. Risk premiums have begun to unwind a little bit, and we'll come on to some of these things. And oil prices have retreated quite significantly, at least as far as I've read over the past 24 hours. And although that's the case, I still think that many business leaders would argue that uncertainty to some extent has not completely disappeared. And the events have reinforced some fundamental questions that leaders continue to ask around: how do we remain financially flexible in an increasingly unpredictable environment? How do we continue investing for growth while preserving liquidity? And how do we make confident decisions when operating in an environment that can change so quickly? And obviously, in the last couple of episodes, we covered sectoral aspects related to transport, energy. We covered some kind of more topics such as supply chain and cyber resilience. Today's discussion is really more about that liquidity and financial position. As always, we will start usually with an economic update. I'm glad to have my colleague here with me, Jing. Jing is, of course, part of our economic policy and strategy team, and effectively will provide us a view on the latest economic update. Her and I are here in Riyadh, and we're joined by two of our colleagues, George and Mo. George is part of our restructuring and debt advisory practice. George works closely with organizations on liquidity, capital structures, financial resilience, and he'll give us some practical perspectives on what he's seen both at a macro and a micro level. Mo is in our tax and legal practice, focusing on M&A and international tax. Again, he's going to talk to us a little bit around how tax is increasingly becoming a strategic lever, not just from a compliance perspective, but actually an enabler of liquidity. So welcome again. And post this, I think we'll take a bit of a break over the summer period, hoping that the stability continues. But Jing, we'll start with yourself. As always, I think our audience would love to kind of get a bit more of that kind of economic update.
Sure. So thanks, Abdul, for the introduction. I mean, look, there is still a lot of uncertainty. Is the strait properly open? Do we need to pay a toll while crossing it? But let's come back to what we do know, which is that, we have an MOU that is finally agreed last week between the US and Iran. Now, it is an interim deal, so not quite the final full agreement just yet. But the key points are that, firstly, the US will lift its blockade on Iran, and that Iran will also allow safe passage of vessels through the strait without charging a toll for 60 days. There are also other provisions, including the proposed reconstruction and economic development plan worth around $300 billion for Iran, which will be implemented as part of the final agreement. And Iran is also now allowed to export its oil for 60 days as well. So setting aside the politics, the reopening of trade through the strait is a welcome relief to the global economy. Oil prices have moderated. And despite some initial equivocation about, whether the strait is open or not by Iran, more and more ships, as you say, are passing the strait. War risk insurance premiums are also declining, which signals confidence that this deal will hold, hopefully, in the interim. But I think we still need to be a bit cautious because for both supply and demand side factors. So I'll start with the supply side in the first instance. So firstly, there are still concerns about safety through some of these transit corridors, especially with mines, which may still need to be cleared, and one adverse incident might see insurance costs skyrocket again. Legal issues also are another concern. So Iran has imposed mandatory insurance on ships that transit through the Strait, which is currently free, but it does raise some questions about the legality of paying these fees later on if sanctions remain. And then second, it will also take time for ships to get back in their right places. So a lot of vessels, due to the conflict, they have been diverted away to other trade routes. So that might take around 6 to 8 weeks to look normal again. And also the pace of normalization for oil production will likely vary across the region as well. So for example, Saudi Arabia and the UAE, production there could probably recover quite quickly. They have the right flexibility, they have very strong operating capabilities, as well as capacity to manage disruption. And in fact, there are some reports that suggest UAE oil production was around 85% of pre-conflict levels already at the start of June. But that won't be the case everywhere. So Kuwait, Iraq, Bahrain, and Qatar have more complicated restarts, because of the extent of infrastructure damage that was sustained during the height of the conflict. Now, turning to the demand side, now in some ways, the price shock at the height of the conflict as well was less severe than was initially feared. So we saw Brent peaking at around maybe $120 to $130 per barrel, which is still, a very high price. But the surprising part for me is that it did not rise further given the scale of disruption that we saw. And actually, if you compare this to previous crises, prices have reached closer to $200 per barrel in inflation-adjusted terms. And the reason for this is reserves, firstly. So globally, both state and commercial reserves have stepped in massively to manage this price pressure, and about 440 million barrels of crude and refined products have been drawn down. The second is demand management. So some countries did have to resort to measures to reduce fuel consumption, such as work from home mandates and so on. But really, the biggest reason is China. So, China is the world's second largest oil consumer. It has cut its imports by around 40% last month compared to the 2025 average. And that is roughly equivalent to the combined oil consumption of France and Germany combined. So had China been buying as much as they used to last year, prices would probably have been far higher. And of course, the accelerated shift towards EVs in China has also helped to reduce its fuel consumption. It has changed its petchem production to adapt to new supply constraints. But the biggest driver is its massive crude reserves. So, we don't have full public information on this, but it is reported that up until the conflict, China had stockpiled about 1.3 billion barrels of crude. So that has provided a huge buffer. Now, the problem is at some point, you're going to need to have to restock these reserves and inventories. And so that could actually create a burst of demand and renewed price pressure because, many of these are also approaching operational distress levels. So these will need to be restocked very soon. And so while on paper there is indeed a path to normalization, this won't necessarily happen immediately. So I think that, in the short to medium term, there is likely to be somewhat of a price floor for energy prices. Now, what does that mean for the region? So, obviously for us, high prices are not necessarily bad news. And, if anything, higher oil prices will boost fiscal revenues at a time when it is most needed for rebuilding, reinvestment, and for restoring confidence generally. But we do need to be aware of the inflation risks as well, especially if oil prices do remain elevated in the short to medium term. And it will take time for some of these effects to play through the economy as well. So, and that will matter for interest rates and financing conditions. And at the latest Federal Reserve meeting, rates were held steady as well. And there was a very clear signal from the Fed that inflation risks are still elevated as the supply shocks are working itself through the economy. So as a consequence, financing conditions, which the other guys will also comment on shortly, may remain elevated for some time. But I think just in terms of the path to recovery, so hopefully there should be a rebound in confidence now that an MOU has been agreed, but confidence may not necessarily return that quickly to normal, but assuming the deal holds, I would expect recovery to begin in earnest in the next quarter. I would expect the oil sector to recover relatively quickly because, especially for the big producers in response to pent-up demand. But as I said, the pace of that recovery will differ across the different GCC countries. The non-oil recovery may take a little bit longer. Logistics, aviation, tourism, business confidence, these do not normalize straight away, but I would expect this recovery to happen, maybe in Q4 this year. And for 2026 as a whole, growth across the region is expected to be either flat or maybe a little bit negative, but we will see a much stronger recovery in 2027. And economies with stronger oil production recovery, with stronger fiscal buffers, they should be in a stronger position to rebound as well. So, Oman, Saudi Arabia, and the UAE are in a comparatively stronger position. Just as a quick wrap up, again, the deal is very much economically positive for the region. It allows energy and trade flows to renormalize. It should help inflation and confidence as well. But we should still be very much aware and alive to inflation risks. Confidence may take time to recover, but I do believe that the region's long-term investment fundamentals are still remaining and they remain strong. So let me pause there.
And last time, of course, with your colleague Richard, we covered the V-shaped, U-shaped scenario. I think we're well beyond the V-shape. So as you rightly say, when that recovery kicks off, hopefully, with no further kind of disruption, that will in itself take a little bit of time. And he was drawing parallels with prior crises and that 18-month, 2-year period, so that we get to where we were the situation.
Pre-conflict, yeah.
Yeah, the pre-conflict that we've experienced. Okay, so expectation as well. One of the things we discussed is this structural? Do we expect to see things? But it sounds like no, the Strait of Hormuz will continue, of course, to be as important. Maybe there's a bit of question marks around some of those kind of levies and hopefully final signature beyond the MOU, but maybe the big structural kind of shifts in oil trade, etc., maybe not for now.
Yeah, I mean, look, I would say that I think in terms of risk premiums for the region, I don't think hopefully this deal holds, but I don't think investors are necessarily hugely sort of pricing in significant risk premiums. As you say, I think these have moderated somewhat. But I think, if there is a continued concern that these conflicts, such conflicts may flare up again, there may be a structural, impact that gets baked into investors' sort of financing considerations. But I think in terms of infrastructure, so, the Strait will still be an important trade route, but it may no longer be as critical as what it used to be. So, countries are much more aware of their dependence on single choke points. And it is inevitable that the crisis, exactly, 100%, there will be a greater push for alternative pipelines, alternative routes, additional storage, and so on. And you'll find that, infrastructure investments that create these redundancies, which were maybe shelved in the past, will be rethought now because it is probably more justifiable on the basis of needing to build in resilience.
Clear. All right. We'll pivot to George. So welcome, George, again to our webcast series. I guess taking it down to that kind of business and still at the macro level, I guess, in terms of what are we seeing from governments here in the region, maybe overall views on what we're seeing, liquidity, etc., before we go into the kind of enterprise level, maybe your perspectives, if you don't mind.
Yeah, thanks, Abdul, for having me on your series. Listen, the periods during these such similar periods, governments have demonstrated historically and currently their willingness to deploy targeted measures and schemes Typically, these are relief schemes that come into play to help companies during stress periods. We also have seen banks show some kind of flexibility, informal flexibility, in the form of covenant waivers, maturity extensions, repayment reliefs, and proactively having refinancing discussions with their clients. So, on a macro level, both the governments and the capital deployers, the banking system, have acted and are currently acting in ways to provide some form of a cushion to help companies navigate the current situation. The key thing here is that these cushions are not enough or do not act as a risk eliminator. The burden does sit with the companies to be more active and really focus on building resilience. So these cushions are meant to help companies buy time, but companies need to leverage that time in order to achieve resilience. And resilience, simply put, can be achieved if companies manage to, strengthen liquidity, improve their productivity, optimize their working capital, proactively manage their debt, build resilient supply chains, and continuously do stress test scenarios.
Hold that thought, actually, because we'll come on to the enterprise picture. And by the way, just as an ask, if we have viewers that want to submit questions to our panelists, please do so that we can pick those up at the end of the session. So Mo, again, thanks for joining us. I guess sticking to that macro level, and maybe a bit more of your reflections on what Jing and George have said, and maybe bring a bit of that tax authority and government perspectives and what you're seeing from your end.
Yeah, no, thanks, Abdul. And again, just to echo what George said, thank you for having me on your series. Look, it's a similar sort of message from a tax perspective to what George just articulated. We're seeing tax authorities trying to manage short-term taxpayer support with more medium and longer-term tax resilience. So revenue collection and digitization, tax reform, and ensuring taxpayers comply with their tax obligation. So to give you a couple of examples of actions that tax authorities are doing, they can include things like transition support, so where you're moving to more digitization, like e-invoicing, for example. They're giving a bit more breathing room to taxpayers to be able to prepare for the implementation date. So take the UAE Ministry of Finance. We've got e-invoicing being implemented from the 1st of Jan 2027. So whilst that date is not changing, there are certain intermediate dates that the tax authorities pushed out to allow taxpayers that room to be able to prepare for that 1 Jan start date. We're also seeing some level of tax relief as well. So if I look at the Saudi tax authority, they've got in place a tax amnesty. What that does is it allows taxpayers to regularize their tax compliance obligations, bring it up to date without having the burden of having to pay penalties and interest on any sort of historical non-compliance. That's been actually in place for a number of years. That continues to be extended, and we probably expect the Saudi tax authority to continue that sort of measure to support taxpayers. Again, I'll echo what George was saying around proactivity. There's quite a bit of emphasis around what taxpayers are doing as well, and actually being proactive around engaging with tax authority during this challenging and uncertain time. So to the extent there's a discussion around managing liquidity through deferring certain tax payments or paying taxes in installments, I think we've seen tax authorities open to having those sorts of conversations. So being proactive, being open, being transparent with tax authorities is important, but also being able to recover your overpaid or your tax receivables are pretty important, and that requires, again, that open and transparent conversation with the tax authorities. So I think the overriding message I would highlight is tax authorities are not stepping back from tax reform. They're going to focus on their digitization agenda. They're giving a bit more breathing room to taxpayers, I should say. But I think it's important for taxpayers to be proactive and be able to optimize and use those reliefs and transitional support that the tax authorities are providing.
And I guess, Jing, coming back to you, of course, with oil prices, kind of like you said, there's a floor, there's hopefully a little bit more room, because ultimately that fiscal space will dictate a lot of what will be done across both what George and Mo kind of commented on. So you know, that's the scenario.
Yeah, definitely. I mean, look, the most of the countries, well, some of the GCC countries are in a better place than others. But I think they face two pressures, both on the revenue, you know, on the revenue and on the expenditure side. And I think, you know, certainly on the revenue side, to Mo's point, there will be a stronger, I think, emphasis on ensuring that revenue volatility can be managed from a fiscal perspective. And so, you know, there may be some of these policy measures that are temporarily put in place and reliefs and so on to support the wider business community. But I think going forward, there will be a much, I think, bigger focus on strengthening the revenue base to ensure that this can be sustained, you know, through periods of volatility. But I think also on the expenditure side, you know, clearly there are still very ambitious diversification agendas and investments that still need to be funded. And if anything, you know, what this crisis underlines is the importance of accelerating progress on those fronts, especially on industrialization, investing in, you know, potentially in the defense sector as well as localization. So all of that will require, you know, continued massive investments that need to be funded.
Yeah. Okay. Thanks. George, now kind of stepping into that enterprise kind of corporate layer. So, of course, a lot of lessons learned for businesses out there. But again, when we're talking about what are some of the things that they really have learned coming out of this at an enterprise level, maybe if we can deep dive into a bit of that, and how should they ensure that they deal with disruption a lot better next time. So what have we seen from the leaders that you've been speaking to?
See, a lot of the situations like this create some kind of bias, right? We have that event bias. So the biggest mistake that companies could do now, Abdul, is basically try to avoid the risk that we've already experienced right now, right? That is not the real risk. That risk could, in the future, you know, the risk could be a supply chain risk, a interest rate risk, a regulatory risk, all sorts of risks, right? So the key thing is right now, the big lesson for CEOs is how can you make your business more resilient? And, you know, to do that, businesses need to stop thinking only about revenue and quarterly profits. And that's what I continuously discuss with boards in the region. We need to broaden the focus. We need to bring in other key metrics that are very important for the resilience of our businesses. Things like survival days, right? Which is a very simple metric. It's basically dividing your cash available by your you know, the monthly cash burn rate, right? So things like that are critical to, and usually are the differentiator between a business that can grow in the future, can be sustainable in the future, or can face a failure in the future.
Yeah, and I guess going back to what Jing had mentioned, so, you know, obviously somewhat of a bounce back in economic activity, hopefully expected, and certainly in terms of what we've seen. So it's important that they don't, you know, cut too much or take decisions that might hurt them when that bounce back happens. So again, maybe a bit on that in terms of how should they improve performance during a situation like this to then kind of be able to bounce back in line with economic activity.
Yeah, no, absolutely. Listen, the fundamentals of the region are still here, right? So we are, you know, we're fortunate enough to be in one of the most active regions in the world economically. And there's a number of transformational programs happening across the region. So businesses do need to be sustainable, be resilient to capture that growth that is expected in the next 10 years after we come out of this situation. Now, again, another big mistake that companies do is when faced with stress, is they go into panic mode, and sometimes they undergo cost-cutting programs, some of which are really necessary to be more efficient, but some of which can go beyond cutting fat and go into the cutting of the muscles, cutting the brains of the company. So we need to be really careful during this period. Broad-based cost-cutting programs need to be really thoroughly thought about and challenged in this environment. I think the most effective question that companies need to ask themselves is not what can we cut, but rather what can we eliminate, what can we enhance, and what can we ensure. You need to be able to eliminate those processes that are not adding any value and are actually leaking cash. You need to be able to enhance those systems and processes in place and activities that are creating resilience and helping you build that resilience. And most importantly, you need to ensure or protect the activities that are your competitive advantage. And this is how you can capture the growth going forward. So companies that are gonna emerge strongest are usually those that will continue to invest during these periods.
Yeah, thanks. Mo, your reflections on tax and kind of linking it to that working capital that George is talking through. So maybe from your discussions with organizations in the region.
Yeah, thanks, Abdullah. I think some of the points that George has raised resonates from a tax perspective. I think tax is quite often seen as a cost center, right? It's a cost that the business has to suffer as part of their typical operations, right? Actually, I see it as slightly different. I see tax as a value driver. It's a lever to actually being able to release certain parts of your working capital structure in as quickly a way as possible, provided your systems are robust, your internal gaps are managed, and actually you can get back the taxes that you may pay in advance to the tax authority quickly. So what do I mean by that is, where is cash typically trapped within a tax system? Quite often you'll see businesses pay their suppliers, suffer input VAT that otherwise would be recoverable, and for some businesses actually can be refundable from the tax authority. That can take months, if not sometimes years, if your documentation is not in order, if the invoices you receive from your suppliers are incorrect, which are quite often an issue I have to deal with when I'm working on M&A projects. Are your systems and your reconciliation, your documentation in place for you? Are they robust for you to be able to go to the tax authority and say, look, here's my current situation. You've got X amount in your bank account. I'd like that back, and I'd like that back quickly. Quite often, having internal gaps and documentation reconciliations that are not robust can delay that process. So actually, if you're a tax function, if you're a head of tax, if you're having that conversation with the C-suite, it's important to push tax as a really value driver to unlock working capital. I think that's really where I would say that this resonates. Tax is just not a cost. It is a potential value driver. Yes, you've got to pay your tax. Quite often you have cash that's trapped in a tax system that can be unlocked if you can get your so-called house in order.
So Mo, maybe we stick to that topic, because I think you talked about it in the context of how you can release some of that and have those kind of transparent discussions with authorities. But at the same time, is there more structural stuff? Because on operating model, things that organizations need to really push to really take that lever to the next level beyond just the existing status quo in terms of how an organization is structured?
I think that's a great question. I think quite often in uncertain times, taxpayers and businesses can take a step back and, to George's point, look at cost cutting. Actually, I think when you use tax as a tool to unlock value, looking at your corporate structure, looking at your operating models, how the business actually functions, is really, really key and can unlock some of that value. So what do I mean by that? If I focus on each point in turn, when you look at a corporate structure, quite often you'll see that it can be quite punitive from a tax perspective to move cash around the business, around your structure, to get it from where it currently sits to where it actually is needed. I'll give you an example. I was working with a global multinational which had presence in LATAM and had a large pool of cash in LATAM. It actually needed that cash sitting back in the Middle East, but struggled to get it back. Why? Because if it paid it out as a dividend, for example, its corporate structure meant it would suffer a 30% withholding tax cost. It wasn't able to get relief on it, so it couldn't pay a dividend out. That's punitive. To have a large pool of cash on which there's an immediate 30% value erosion is problematic. So actually looking at your corporate structure, allowing a structure or creating a structure to the extent that you can that allows cash to move around is really important. Sometimes you're locked in because of legacy structures. That can be difficult to address, so you've got to look at other mechanisms to move that cash around and transfer pricing it, and the mechanisms that transfer pricing allows you to have could be something to look at. But actually getting your house in order to allow future expansion, be it organic, inorganic, in a way that creates these efficiencies is really valuable. That's the corporate structure side of things. I mentioned transfer pricing. That's particularly relevant in the second part, which is the operating model, right? Quite often, what I see is profits and income and cash being booked in entities and countries that really don't house the value drivers of a business. So you look at procurement hubs, you look at your IP ownership, you look at your development teams, your C-suite, you look at your shared delivery centers. The value and the income of a business can quite often not sit where those value drivers are. So actually looking at your operating model, looking at your transfer pricing, how you're charging between entities and countries for those value drivers is really important to be able to move that cash around and unlock it for use in your business. So tax is really, really critical, and that's particularly important in these uncertain times. So again, I echo and I repeat broadly what George said, which is you can focus on cutting costs, or you can look at actually restructuring your business in these uncertain times to allow that resilience on a more longer term basis.
Clear, thanks. And maybe, George, we've spoken a lot about cash and relationship with authorities. Let's talk about the ever so important relationship with banks, especially during difficult times. And in our conversations, that whole, how much of that relationship do you ultimately manage in a crisis versus proactive? What's your summary of advice that you have for companies in terms of their own relationship with their lenders and debt in general?
No, sure. I mean, this is a great one, Abdul. Just give me a second, just to cover something really important, which I think gets overlooked sometimes and we talked about it briefly, the working capital piece. Really, when you are, as you build resilience in the system, you want to try to get very efficient at getting capital, okay? And the cheapest bank that we have available to us sits in our balance sheet usually, right? This is the working capital balance sheet. Simple things like improving collections, optimizing inventory, renegotiating your payment terms with your suppliers. Very simple terms can have very meaningful impact on releasing locked cash in your balance sheet, okay? So I just wanted to make that important. This is very important in creating financial solutions. You don't, no sponsor injection needed, no equity raising, no shareholder dilution, no additional debt. This is all built within the system. Let's capture that as we start talking to banks. And that brings me to the bank side. Listen, the banks in the region have gone through a number of these situations. They have become more sophisticated. They have most of them have built workout teams or restructuring teams into the system, and they are starting to infuse the sustainability agenda DNA within these workout teams. So the big mistake that we can do as corporates is try to hide our issues or our weaknesses with our banks. Banks should be treated like partners throughout the life cycle of companies, but more so during distress. Okay, so our relationship bank should now shift into our restructuring bank. That is the mentality that needs to govern this process. And here it's about really working closely and proactively with the banks. That's we've been talking to banks. I talk to banks every day, Abdul. Okay, and there's one clear message coming through. During this time, banks are under a little bit of pressure, and it's basically operational pressure. It's administration pressure because they used to have their NPLs. Now they're looking more on the cases that are sitting on the fence, and then they are looking at, are there any systematic risks that we need to think about? So they are under a lot of administrative pressure right now. This is the right time, and this is when they expect, and this is what they've been telling me. We want our clients to come forward to us. We want our clients to be more proactive, to bring forward the narrative, to bring forward the discussion, bring forward your business plans. Show us that you've done your scenario analysis. Show us that you are doing enough when it comes to preserving cash. Show us that you're doing enough when it comes to cutting costs. Show us that you're doing enough to avoid any covenant breaches. If you need help, come in a more proactive way. Ask us for that help, but come ready. We are ready for that. So the message that's coming out from the banks is that they are willing to support, but they want companies to be much more proactive and deliver much more transparency when it comes to information.
Thanks, George. When I think of companies having a discussion with their bank around their business plan and what they foresee, I mean, it's difficult to kind of divorce that discussion from implications on AI and productivity. Is that featuring at all in those conversations? Because ultimately that could allow for a bit of that. But I guess there's a lot of expectations from AI, whether it's from governments in terms of boosting productivity and impact on the economy. And then we'll kind of pivot on that. But are you seeing that at all in terms of expectations from productivity and what that has from a business plan perspective and discussions with them?
Yeah, so we're seeing banks are becoming, the expectations there, Abdul, you're right. But it's more on how banks are using AI themselves. And basically helping them as systems understand if they have any systemic risk or not. So they're looking at deploying, and they are deploying a lot of these early warning systems in place. Now, when it comes to the conversations with their clients, AI is high on the agenda right now in terms of discussions with their clients. But I think it's in the early stages of the discussion. I wouldn't say that it is the key point in this discussion.
Thanks, George. From yourself, Mo, what are we seeing from that perspective? Are companies now utilizing this to kind of make better judgments, or maybe at least helping them in terms of decision making in that space?
Yeah, look, thanks,
Abdullah. By all means.
Yeah, look, I think there's a few areas that are relevant in the context of tax and AI. And I've got to be slightly careful about how I articulate myself, because I wasn't fully bought in on AI before. And I say I need to be careful because my wife she's an educator and she's focused on AI. So I was always slightly hesitant around the impact of AI in terms of what we do as advisors, but also what our clients do and what tax authorities do. I think the timing of this question is really important because I'm fully bought in, absolutely bought in. I think AI is going to be fundamental to everything we do. Be it, again, as advisors, but also for our clients and for tax authorities. And again, I said earlier, there's a few things. There's a few areas where this is particularly relevant. Talent is one. We've been talking about conflict and resilience related to conflict. There is effectively, and I choose my words carefully here, there is a war on talent, and there is resource scarcity, and there are, as a result, gaps in terms of how we operate from a tax perspective, if I focus on tax, in terms of tax function, gaps in terms of the value that the tax function can bring, as I discussed earlier. How do you bridge that gap? AI is going to be fundamental to that. And I think AI will effectively eliminate those gaps very, very quickly. And our approach to talent, I think, will just naturally have to change as a result. You mentioned tax authority. I think we're seeing, this is not just for the Middle East, but globally, but in particular now Middle East is becoming more and more important, is around integration of taxpayer systems with the tax authority systems, effectively live, up-to-date compliance. I mentioned e-invoicing earlier. That's going to come into effect in the UAE from the 1st of Jan 2027. That effectively means you give live data to the tax authority. Your tax authority has access to to taxpayers, not when they file a return after X number of months and years from the point at which the return relates to, but actually on a live basis. So AI is going to play a really important part in that. I think the other part of this is, and connected to compliance, is around how AI integrates with your system and the data that you have. How can AI help you manipulate your data and use your data in a way that helps you comply from a tax perspective? I'll give you a specific example. For large, very large global groups, there's a regime called Pillar 2 that applies, which effectively, for some groups, increases their tax. There's specific compliance that's required for those groups. The returns that you have to file touch upon over 200 data points within your systems. That's problematic for businesses, because we discussed this with CEOs as part of our CEO survey earlier this year, and AI was top of the priority list for CEOs, but they acknowledged that actually AI is not properly embedded into their system, so can't access the data in the right way. And the problem with that, when it comes to things like Pillar 2 and tax compliance more generally, if you're not pulling out the right sort of data, you may be not complying in the right way. It's, in simple terms, garbage in, garbage out. So you can get the best AI tool, but if you're not feeding it with the right data points, that's also problematic. Technology and AI plays an important part to really clean up your data and make sure the AI tool has access to the right data points within your business. One final thing I'll say before I pause to let you react, Abdullah, but also to take a breath, is, look, AI is going to be key. It's not going to replace the human element. It won't replace human judgment. So complementing AI with your human capital in your tax function and tax management is going to be absolutely critical.
Yeah, no, we keep on. You reminded me of a kind of a video I saw and someone talking about human in the loop versus human above the loop, and kind of how that could apply in a tax context. There are a few questions, Mo, just in terms of generally what are we seeing in terms of tax reform. Obviously, we saw some sprint of those prior to the geopolitical tensions and conflicts that we've seen. You know, any views in terms of what's coming, what's confirmed, or how do we expect governments to react? You know, not that I'm expecting you to have a crystal ball, but any observations there?
Look, we have some insights around some specific reforms that are coming in. We know, for example, Bahrain, which has historically not had a direct tax regime, is bringing a direct tax regime in, and that's going to come in from next calendar year. So we have some insights around some specific changes. We also know that the region as a whole is pushing towards tax reform. That's no secret, and that's been happening now for a number of years, for the last 5 to 10 years, right? We've seen corporate tax regimes being introduced. UAE is a prime example. VAT regimes being introduced. Saudi, UAE, we're expecting it in jurisdictions like Qatar. It's just a matter of time. And Kuwait. We know Kuwait is also looking to reform their tax legislation. They've been at the forefront of introducing things like Pillar 2, like I mentioned, that will require a transformation of the direct tax regime. We know that's going to happen. It's just a matter of when. So transformation of tax and tax reform was always on the agenda. I think this sort of uncertainty, and I think Jing talked to it earlier, it will accelerate the need for tax reform. I think constructive tax reform to encourage businesses to continue to invest in the region, to continue to encourage that human capital to come into the region, but tax authorities will need to build that revenue resilience. And one key way to do that is through tax reform. And I think the last thing I would say on this point, and there's probably a lot more we can talk about, is around diversification, right? It's been an oil-focused region. I think well, not just tax authorities, but governments are really looking to diversify. Part of that is through tax reform. You encourage businesses to come in, you use the economy, you contribute back through taxes. So I think we're going to continue to see a theme of tax reform. I think that's great to see, and I think it will move in the right direction when it comes to building that revenue resilience, but also encouraging businesses to continue to operate and set up and expand in the Middle East region.
Thanks a lot, Mo. We are running a little bit over, so maybe final reflections maybe from our panelists. So Jing, what's, you know, as we're stepping into the summer period, latter half of the year, what is the one thing that CEOs should be looking out for, reflecting over the summer period, I guess, at a macro level?
I mean, for me, the main thing is just not being complacent. I think it's great that there is an interim deal now, but it is still, not confirmed if a final agreement will be reached. And, diplomatically, that's quite a challenging thing to achieve as well. And there is also the risk that the conflict may also flare up again, later in the year. So I think the important thing is for businesses to continue building out their resilience and ensuring that they can still continue to operate if shipping routes are disrupted again, if insurance becomes more expensive, or if some of their key inputs are, not accessible. And I think beyond this, we live in a more volatile environment in any case. So, businesses do need to be prepared for greater macro and financial risks.
Okay, all right. I'm not sure if that's half glass full, half glass empty, but I'll err on the half glass full. From yourself, George, any kind of one thing CEOs should look out for as they step into the summer period? Q3?
Listen, going back to resilience, I don't believe that the companies that will survive in the next 5-10 years are going to be necessarily the biggest companies. I don't believe that they will necessarily be the fastest growing companies. I do believe that they will be the most resilient companies. So that's that, focus on resilience. And if we just one more thing on banks, connected to resilience, again, banks dislike losses, but they dislike surprises even more. So be active, be proactive, and reach out to the banks as soon as possible.
All right. Mo, parting words from your end?
They say you save the best for last. So look, I would again echo the theme around resilience. And I think from a tax perspective, I think that requires some self-reflection, some self-focus, looking at some of the points we talked about, actually using this period of uncertainty to look at your corporate structure, your operating model, but in particular, AI, how technology and AI can support your business, at least from a tax perspective, but probably more broadly, but in particular from a tax perspective, and flip tax from a cost to a value driver.
Okay, fantastic. Thank you very much, lady and gentlemen. Really appreciate you coming on the webcast today and sharing your views and observations. And thanks to those of you who were able to join us this afternoon. We will take a bit of a break over the summer period, and we'll hopefully see you right after on our next webcast. So thanks, everyone. Good afternoon, and bye-bye.